Hello everyone. When we contemplate the probable outlook for asset classes in 2022, we think there are three known unknowns that are likely to determine how financial assets will perform this year. Let's call them the three Ps. The pandemic, politics, both global and local, and probably the most important, global policy. While it is known that these variables are going to be very important for the outcome of financial markets this year, it is unknown how these variables will turn out or how financial assets will respond to their behavior. Let's talk about the pandemic first. It seems that more and more countries have started to move away from a zero-tolerance stance towards COVID-19, realizing that the severe economic hardships caused by the strict lockdowns required by such a stance are mostly ineffective in containing the virus and counterproductive for the general well-being of their populations. Even more so if rising vaccination rates minimize severe illness and mortality rates among residents, or if new virus mutations become less lethal. As a result, the negative growth impact of each new COVID mutation wave is likely to become less severe going forward, unless vaccines become less effective against new virus variants, or if new mutations become more fatal, which would then lead to renewed spikes in hospitalization and mortality rates and a much more severe economic downturn, or even recession. What about politics? Well, financial markets would be roiled when there are increased geopolitical tensions, as now seen between Russia and the West due to the Ukraine invasion, or between the US and China, whether on the Taiwan issue, military tension in the seas around China, or altercations on the trade front. As always, North Korea's nuclear ambition and instability in the Middle East continue to lurk in the background as potential additional threats to geopolitical stability. If we use the Russian annexation of Crimea in 2014, the American invasion of Iraq in 2003, and the 1990 Gulf War as our signposts, this chart shows that the effect of Russia's invasion of Ukraine on financial markets is likely to be marginal and temporary. While the global equity market has been pretty weak in the run-up to these previous conflicts, the markets recovered pretty soon afterwards. Of course, the Russia-Ukraine conflict will naturally be associated with high levels of market volatility, as long as there is uncertainty about how events will ultimately unfold. Our basic premise is that if Russia-Ukraine remains a regional conflict that does not escalate into a global destabilizing event, it should fade as a meaningful driving force for financial markets beyond the short term. In the interim, risk-off sentiment will likely be prevailing at times of tension escalation, with risky asset classes like equities experiencing some short and shallow drawdowns, and safe haven asset classes like the US dollar, gold, and global bonds rallying during these periods of conflict escalation. In our view, geopolitical events like these are likely to only be secondary factors to the more primary fundamental driver for financial markets this year, namely the major global policy transition from the massive monetary and fiscal stimulus of 2020 and 2021 to eventual policy tightening in 2022. How financial markets react to this policy pivot will be much more crucial for the relative performance of different asset classes than what happens in Russia-Ukraine. At most, the situation in Ukraine reinforces our view that the global policy pivot in 2022 should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes this year. Geopolitical events like these again highlight to investors the advantages of having a diversified investment portfolio. While some asset classes in an investment portfolio could experience short-term drawdowns when risk-off sentiment prevails, think of risky asset classes like global equities, other factors like a weakening rand would soften the return effect for rand-based investors, for example. Similarly, while there could be near-term pressure on South African bonds from global risk-off sentiment and a weaker rand, some South African equity sectors will benefit from higher commodity prices and a weaker rand. Within South Africa, any market-unfriendly political outcomes from the ANC's policy conference in mid-2022 or its elective conference at the end of the year would be quickly reflected in lower local asset prices and a weaker rand. Also, risks to South Africa's economic growth from elevated frequencies of Eskom load shedding in the coming year or disappointing progress on economic reforms would result in an increase in South Africa's risk premium as an investment destination. And now to the big gorilla in the room, policy. 2022 will be a year when we are likely to see a major global policy transition from the massive monetary and fiscal stimulus of 2020 and 2021 to eventual policy tightening. How financial markets react to this policy pivot will be crucial for the relative performance of the different asset classes this year. An exaggerated cyclical global recovery last year from the pandemic doldrums of 2020 was almost inevitable after, firstly, the massive monetary and fiscal stimulus dished out by policymakers around the world in response to the COVID-19 crisis, and secondly, the improved mobility experienced in 2021 versus the lockdown conditions of 2020. In the same vein, a global growth slowdown in 2022 from the heady heights of last year looks a mathematical certainty, particularly against the backdrop of peaking policy stimulus. Not only are the quantitative easing support from global central banks peaking, but a more general trend of rising interest rates will soon become prevalent. Financial asset prices have been hugely supported by the abundant stimulus in 2020 and 2021. The transition in the policy environment in 2022 from previous massive stimulus to less stimulus, then to no additional stimulus, and eventually to policy tightening should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes. How important quantitative easing has become for equity returns is aptly illustrated by this chart, showing that since the global financial crisis, QE in red has become twice as important as a US equity return driver than profits. Before the global financial crisis, profits were basically responsible for almost half of the returns of the US equity market. But after the global financial crisis, this has fallen to only 21% of equity returns. In contrast, the growth in the US central bank's balance sheet is now the driving force for 41% of US equity market returns. In addition to the likely negative equity return impact of the move from quantitative easing to quantitative tightening this year, the anticipated slowdown in profit momentum associated with lower global growth also points to a lower global equity return outlook in 2022. However, the magnitude and longevity of any potential equity sell-off will be limited as long as the global economic recovery remains broadly intact and broad-based, as is currently still the case. At least the anticipated growth slowdown around the world at this stage looks to be mild enough to keep growth rates well above trend levels in 2022. There is, of course, the risk that if global central banks are forced to take a more aggressive policy normalization path in an effort to contain more severe inflationary pressures, this could destabilize financial markets that have become accustomed to historically low interest rates and are priced for a very slow and gradual path to eventual monetary policy tightening. The expected turnaround in the QE cycle going forward should also be a negative fundamental demand factor for global bond yields. This chart shows that in the US, the Fed has been a major demand source for treasury issuance since the global financial crisis, and again since the pandemic. So much so that the Fed now owns almost 30% of all outstanding US Treasury securities. But this Fed demand will disappear when QE ends, at a time when Treasury issuance will rise further to fund huge fiscal programs in the US. The supply-demand dynamics for the US bond market is thus likely to deteriorate markedly in 2022. In conjunction with inflation that is proving to be more persistent than previously thought, this points to higher bond yields going forward. That caution is also warranted on global bonds as rising policy rates loom is evident from US asset class behavior around the start of previous rate hiking cycles since 1977. While US equities in the blue dotted line rose in the run-up to the first Fed rate hike, bond yields in the red dotted line also rose in the run-up to the first Fed hike and continued to rise subsequent to that hike. The recent behavior of US equities in the solid blue line and US bond yields in the solid red line have broadly followed the historical script. If historical precedent also prevails this time, one would expect a volatile but broadly sideways US equity market trend in the next year, and a further rise in US bond yields. What would be more problematic for equities is an aggressive spike in bond yields. For instance, if the bond market perceives the Fed to be behind the curve on fighting inflation. When US bond yields historically rose by 50 basis points in a month, returns for the US equity market were negative in the immediate aftermath of that spike, while returns up to a year after the spike were weaker than normal. It would be difficult to argue that any of global equities, bonds or cash are currently exhibiting great value in isolation, with the US equity forward earnings yield close to 5%, the yield on 10-year US Treasuries close to 2%, Japanese and European bond yields scarcely above zero, and global cash yields around zero. These expensive valuations put a major constraint on the future returns that can be expected from each of these global asset classes in 2022 and beyond. This is one of the reasons why our preference is for South African assets over global assets this year. If US real bond yields rise in line with tighter monetary policy as we expect, this should benefit the rest of the world's equity markets over the US market with its long duration growth characteristics. In addition, as the US equity market has recently outperformed the rest of the world despite an inferior profit performance, this has opened up a record US forward PE premium, which improves the future relative return potential for non-US equities. South African equity market returns in 2021 were derived from a strong profit rebound that overshadowed a valuation derating. This is likely to reverse in 2022, with pressure on profits expected from a slowing in global and South African economic momentum on top of the high profit base created in 2021. This means that returns will have to come from a re-rating in market valuations. Fortunately, the South African equity market valuation picture looks reasonable. Even if we assume no earnings growth in the next year, the South African equity market is now trading in line with its forward PE average since 1999. Also, South African equities still trade at huge valuation discounts to the rest of the world, with South African equities cheap versus emerging market equities, one standard deviation below long-term averages, and very cheap versus developed market equities, more than 2 standard deviations below long-term averages. The global spike in inflation has further eroded the real government bond yields available in the developed world, with most developed countries' real bond yields in significantly negative territory. Although South Africa's inflation rate has also risen meaningfully, the high real yield still available in South African bonds stands in stark contrast to those in the developed world and even among the emerging world. It stands to reason that the high South African real bond yields already discount a high fiscal and country risk premium. But not only are South African real bond yields currently attractive versus developed market and emerging market yields, South Africa's real yield premium versus the rest of the world is also high against historical averages. Finally, South Africa's real yield is also almost 1 standard deviation higher than its own historical average. In the inflation-linked bond space, there is little scope for further break-even widening in the interim, with inflation expected to peak in the first quarter of 2022. Smaller monthly inflation accruals should also provide less fundamental support for the asset class until the second quarter of 2022. After the recent rate hikes by the South African Reserve Bank, the prospective South African real cash yield has risen to above zero, but this is still half a standard deviation below its historical average. Relative to South African equities and cash, South African nominal bonds in red have consistently been the cheapest asset class since 2013. Aggressive COVID-related rate cuts by the South African Reserve Bank have made cash in blue the most expensive asset class since 2020, while sharp profit upgrades in 2021 have pushed South African equity valuations in grey to lower levels. Sector fundamentals in the listed property sector remain negative, with rising vacancies, falling escalations, negative rental reversions with a focus on tenant retention, and sharp rises in operating costs, the order of the day. Our expectation is that listed property values will have to decline by 10 to 15% peak to trough to account for these negative fundamentals. However, values have already declined by 9.6%, so we think a large part of the negative fundamental backdrop has already been discounted. In essence, we need to weigh decent potential property returns from here against the fundamental risks and uncertainties in the sector. So let's summarize the 5 key takeaways from our outlook for asset classes this year. Firstly, the transition in the global policy environment in 2022 from less stimulus to eventual policy tightening should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes. But as long as the global economic recovery remains intact as we expect, the magnitude and the longevity of any potential equity sell-offs should be limited. Secondly, the move from quantitative easing to quantitative tightening and inflation proving to be more persistent than previously thought are negative fundamental factors for global bonds, pointing to higher bond yields and lower returns going forward. Thirdly, although global equities look cheaper than cash or bonds in relative valuation terms, widespread expensive absolute valuations across the global asset classes put a major constraint on the future returns that can be expected from each of global equities, global bonds, and global cash in 2022. In contrast, we think the much more favorable valuation picture of South African equities should enhance the return prospects from this asset class. Fourthly, South African nominal bonds remain the cheapest domestic asset class, as has consistently been the case since 2013. South African real bond yields also remain attractive versus developed market and emerging market yields. And finally, we think a large part of the negative fundamental backdrop for South African listed property has already been discounted. In closing, I would again strongly advise investors to leave it to their financial advisors and investment managers to make sure that their investment portfolios remain positioned appropriately to attain their long-term investment goals. Responding emotionally to any short-term effect that a geopolitical event like the invasion of Ukraine by Russia could have on a portfolio has a high probability of permanently destroying long-term portfolio returns.